So today I'm going to talk about the 4 stocks that I've been buying. So yeah, I'm going to just keep you guys in the loop with what I've been buying, the transparency and everything like that. So as you know, stock market is very negative at the moment, creating many buying opportunities, and I am trying my best to capitalize on them, and these are the ones that I chose to buy recently. I bought these stocks not this week that's gone, the week before that. I was supposed to bring the video out on the weekend, but I just got a bit too busy with doing jobs, I guess. So updating you guys now anyway, so we are going to go through this. These stocks I would like to do a full video on, well, spend a good chunk of time on it in this video, but it would be way too long. The video would end up being like an hour long, which obviously I don't know if you guys have time to watch an hour long video talk about these 4 stocks. But if you do want the full deep dive, I think I've got a full video of them on the channel, but I'll spend 2 or 3 minutes on them, the latest news to do with these companies. So yeah, we'll take a look at these 4 stocks and let's get started. And as always, if you want to know what I'm buying and selling in real time, not a week later, then the place to be is on the Patreon. That's where I do post my buy and sell alerts, as well as 2 exclusive videos a week on the Patreon. So go take a look at that. So yeah, we're going to start off with number one being InMode. I've had a few of you guys actually ask me about this one, saying, is there any chance I'm going to talk about InMode? Am I going to be buying any more InMode? And I generally did think I bought some more InMode. I think it was about like 3 weeks ago. So yeah, I've been buying this quite heavy, I would say, in this dip. InMode is like a perfect summary of like a company or what kind of market that we're in right now. I was actually at one point up 400% on InMode, and that's totally reversed. I'm actually up only like 20% or something right now, which is just insane. So kind of sums up the market that we're in. And you know, a company like InMode has basically gone nearly to the prices that it was at in this kind of, you know, peak CV situation. You know, I started buying this around June time, I think it was. I've averaged up a fair bit since that time, because I thought, okay, this company's made so much progress in the last 2 years, it's not going to go down to prices it was 2 years ago. And it's happened. So it just sums up the market that we're in, I guess, and proves that you just generally don't know where stock prices are going to go. Like, you can think, no way is it going to go to them prices, and then it happens. Hey, a market always keeps you on the toes. But yeah, I can't believe InMode's down these sort of valuations. Like I said, basically nearly getting to the prices it was in peak CV. And you look at the progress this company's made in the last 2 years, it's just absolutely insane. Trades down at 11 times earnings, which is absolutely ridiculous. Like, a company like this should be trading at like a market premium of like, you know, 30, 40 times earnings. So, I mean, it's always a bit of a strange one talking about like valuation and like metric expansions. If you ever read 100 Baggers, the book, it's absolutely worth a read if you're into a bit more like growth stocks. And InMode, you know, it does kind of come in this category. Like, when you factor in the growth in the next few years, I think the growth is obviously going to take it up a fair bit on its share price. But I also feel like, you know, this metric expansion is going to happen. I can't see InMode staying at 11 times earnings when it does the numbers that it does. It's just scary. In case you don't know, InMode basically makes technology for appearances and to help appearances by more avoiding the traditional surgical methods of, you know, cutting in, going to sleep, and having maybe fat removed from a body part, and then obviously that might make it look a bit better. And this does it more by technology of where you don't have to be put under sleep, you don't have to go to a knife, and it like technology like heating up fat tissue, and that will burn the fat tissue and everything like that. So that's just an example of this. One of the technologies they have plenty. You know, go check out the investor relations if you want more detail on that one. But the actual recent earnings were absolutely fantastic. They're buying back a ton of shares because they generate good amounts of profit, great profit margins. The recent earnings were strong once again. You know, 31% year-over-year revenue, still fantastic growth there. Outlook was still pretty strong. Gross margins are at 84 to 86%, which is absolutely fantastic. And if we just pop on Simple Wall Street, by the way, if you do want to join Simple Wall Street, there's a link in the description. Join through there, you'll actually get a 30% discount code. I use it in all my videos. I think it's an absolute fantastic platform. They actually think that the fair value is actually $72. But if we just look at the future growth, you'll just, I mean, look at this. The growth has been phenomenal. It still should grow like 20+% a year. Earnings, apart from this year, you'll see that the earnings are a little bit flat this year. The reason why is because they've got to start paying taxes for the first time. So yeah, that's going to keep the profit down a little bit this year, but that will come back again going forward as the revenue keeps, you know, going up. But look at the profit. You know, they're making so good amounts of profit here. And you look at the like I said earlier, you look at the company's progress in the last 2 years. 2 years ago when it, kind of IPO'd really, you're talking, 57 million in profit, 166 million in revenue. And now it's 377 million in revenue, 169 million in profit. It's just insane. And it's just exactly the same value, which is just stupid. Financial health wise, like I said, it's a great balance sheet, makes good amounts of profit, sitting on 400 million in cash. Could potentially go buy out a company, potentially use that for more share buybacks. It's just phenomenal. You look at the ownership, it's a founder-led company. You can see here the founders do own a good stake of the company, as you can see here. The only little downside is that they have been reducing their stake a little bit, and they have been selling the shares off, which fair enough because they have been on quite a good run, and it's also after an IPO lockup. So it would be good to see them actually come in and buy some shares now, but it is probably worth pointing out they have been releasing a lot of shares at the moment. But yeah, just pointing that one out for you. I guess it's probably the only negative that I do have with this company is that the insiders are selling, and I guess that I've always said the only other negative I could say with this company is that you look at 2 times or 3 times sales, it trades at like 70 total enterprise to EBITDA. Is it actually like, is the number so good and it's so cheap that it's actually like fishy? There's something going on here, but yeah, that's probably my only issue with it. But I think this is, it's 11 times earnings. 11 times earnings is probably worth taking that risk, I would say. So yeah, that's InMode. Number 2, UK stock, SR Capital. So I think this is a fantastic UK stock. I would say this is probably the best growth stock in the UK stock market. Have done since I've been buying this one. Same again, I started buying this one a while ago. I'd say about a year and a half ago, I'd say. Thought, okay, I don't think it'll have a pullback to these sort of prices, and it has done, and it's even gone past that. We're kind of going, once again, we're talking about a stock that's nearly, pre-pandemic levels, which is just crazy when you look at the progress of the company. I mean, I'm trying to justify why this has lost 71% of its value. It's had some audit issues, which it's resolved now, which is absolutely fine. Also, there's a bit of worry that there's going to be a slowdown in this kind of marketing space that SVAR Capital is in. Not that it's shown in the financials at all. It's lost 71% of its value, but when you look actually at the financials of the companies, especially in the recent earnings, which was on the 30th of May, SVAR Capital's gross profit and net revenue continues to be ahead of market guidance. So this company's had no slowdown. Reported revenue was up 70%. I don't know what it is really. I don't know if people were worried still with the accounting issues, but they've resolved it now, and it's like, so why are we still down here when we've got these accounting issues and they're being resolved? Or is it because there's a worry of a slowdown, but yet there's not a single anything being shown here that there's some sort of slowdown happening in SVAR Capital? I'm not sure. I just think it's a very overblown sell-off that has created an absolute amazing buying opportunity in this stock right now. So yeah, I think this is a really good valuation for this company. When you look at the company, it does trade down at 1.9 times sales, which is very low when you look at the company here. If I can just before I go on to that, I want to point out that it does have 81% gross margins, which is just insane. So I know this company does lose money currently. But very soon with gross margins like that, it will put in good amounts of profit. So I just wanted to point that one out because I think it won't be too long until we see the profit go up. By the end of next year, it's actually going to put 1.2 billion in revenue according to analysts, which would actually put it nearly to below a 1 times sales, which is just insane for a company that's growing at these sort of rates. And then potentially talk about profitability start ramping up quite a bit, especially with 81% gross margins. Yeah, it's scary. Balance sheet is still pretty strong at 38% debt to equity. It has been increasing its debt slightly, and the reason why is because it's been making a lot of acquisitions, which I'm happy with. I would be careful that I would not like them to go above 50% debt to equity. That is my only little concern here. But as long as it keeps making these acquisitions that are driving the growth forward, how it has been doing previously, I'm happy for them to do that. So yeah. Got no problems there. Ownership wise, there's been a bit of buying and selling. I would say there's probably a lot more buying than actual selling, which is obviously positive. And the main person that you probably want buying is obviously Martin Sorrell, who is the founder, who is also the chairman of the board. And he's been increasing his stake, which is obviously really positive. And you can see here he actually does own 9% of the company as well, which is really positive. So yeah, this is, for me, the best UK growth stock on the market. I think this is very, very low valuation for this one when you look at the growth, the balance sheet, the potential profit in the future. And I think when you factor in, okay, they might get affected slightly by a recession, but this much, and there's not any sign of it yet, I think it's a bit overblown. So, I mean, without doubt, I think S4 Capital should be already, you're talking a £5 stock plus. And I think I still think that's quite cheap, but I think, yeah, £5 for me, at least a £5 stock. This should be at least a £5 stock. It should never have gone below £5 in my opinion. And then I think you could even say it should be a lot higher, especially when you look at some comparisons for any other companies in like the US, for example, that does the same sort of numbers that this does. So yeah, fantastic opportunity here. Next up, Google. So I am trying to make Google ideally a top 3 position. I would actually not mind Google coming my largest position, to be honest with you. Very rare for Google to have any dips. It's down 26%. It's very rare for Google to dip more than 10%. So a 20% dip. I mean, if we even go peak CV, it was like 28% there. So that kind of shows you, like, even in that sort of period of time, let's just go through the Great Recession. So the Great Recession was the last time it had a major dip, like, that was 50%. So yeah, when you look at this, it's the biggest dip for like 12 years. Trades at 20 times earnings, which I still think is quite cheap for a company like this. You think of the moat, massive moat, YouTube, Google, all the other little partnerships that it has going on, or the other investments that it's making. It's very good. Recent earnings, it sold off its recent earnings, and the recent earnings I thought were positive. Obviously, the only concern was the YouTube side of it. YouTube was a little bit down on what the expectations was, but every other part of this business was growing at really good rates, and it was still growing amazing. That search, Google Networks, and cloud all rose by 20%, which is absolutely fantastic. And YouTube growth was still strong. It was just a little bit weaker than normal, and that will come back soon because YouTube has definitely got a lot of ramping up to do in the next few years. Even profit-wise, it was down a little bit, but on an operational profit-wise, it was still up a very good amount. So yeah, I think that you still got here a company that has good revenue growth in the future, good amounts of profit in the growth in the future, amazing balance sheet, so much cash on there to buy companies or buy back shares, whichever one it wants to do. I think this is, one of the best moats and best profit drivers, balance sheet companies out there. I think this is a amazing stock, absolutely amazing stock. And you look at the valuations, 4 times revenues, EBITDA point of view, it's a 10. Normalized P earnings, it's on an 18 on a forward basis. I think it's fantastic. So yeah, Google is, I think, a very safe bet that in the next 5 years, I expect Google to 2x, and I think it will do that in the next 5 years. So yeah, I'm a big fan of Google. And the last one on this list is DraftKings. Of course, it's one of my priorities to buy this one on this dip at the moment, and I am doing that massively. 5 billion market valuation, is somehow lost 80% of its value from 17th of September. Actually, if we go from here, which was the 19th of March, it's actually down 83%. So yeah, I'm trying to get my average down into like the 20s. I think my average at the moment is somewhere in the 30s. I believe it's like $33 or something. So I'm trying to pull this down into the 20s. If I can get it into the teens, that'll be absolutely amazing. So for me to do that, unfortunately, the way that it's going to have to do that is it stays down here for another 6 months. I know a few people are like, oh, I'm fed up with this market. I don't want this market to carry on dropping. I want it just to go up. And I'm a bit like, yeah, it'd be nice if the market does go up. But at the same time, if the market did go up, I wouldn't have the time to carry on buying stocks at these amazing valuations. And then if it did go up, what would I do? I'd just end up holding cash and have nothing to buy. So actually, if it was to stay down here a bit longer, I could accumulate more shares, especially in this one, because I love DraftKings, as you guys know. It's my largest position. I think it's a guaranteed 100 billion market cap in the next 10 years. I'm in it for the long term, 5-10 years at least. It's the most exciting company I've seen since Tesla, Shopify, Square, since I invested into them sort of companies. This is the next one I've seen. I think that sports betting in America is very, very early days. I think that when you look at this, what this will be in the next 10 years, it's going to be a major, major market. People talk about EVs. EVs is a big market. What's one of the next big ones coming up? It's sports betting in America. The more states that get allowed, and then more states that only, 2-3 years in the launch, even 6-7 years down the line, these states are going to have major, major growth. going forward. And I think DraftKings as well will expand just past being that as well. Recent earnings were fantastic. Beat expectations by a huge amount. Raised the 2022 guidance. Even the adjusted EBITDA was reduced on the losses side of it, which is great. The business itself has acquired Golden Nugget, which will expand from them just being a sports betting company to also a casino company as well, bringing in a different audience, which will be great. So that's a great acquisition they made in the last 12 months. And one of the big criticism that DraftKings always get, and I'll get it in every video when talk about DraftKings, is like, oh, but they lose this much money. They do lose this much money, but you've got to look why they lose the money. They lose it to launch these states. Is the profitability in line for DraftKings? Yes. You look at the DraftKings platform, they've now got 5 states profitable. They're probably going to have 10 states profitable by the end of the year. And the profitability is just getting better and better. The long-term margins are just getting better and better. Insane growth going forward. And if they wanted to be profitable, they could be profitable. But they're expanding, they're making sure they keep this market share. That market share, if you look at New Jersey, always look at New Jersey. That's the state that's been running the longest. You look at New Jersey, the state that they launched in first, like 4 years ago now. It's still growing like 30-40% a year on revenue. It's putting in good amounts of profit now. It's putting in more profit than DraftKings even expected it to ever do. So you're going to have here a business that has very good profit margins when it matures, still good revenue growth. It's exciting. So, I mean, yeah, it's the most exciting business I've seen for a long time. And that's why it's my biggest position, because I learned from a few years ago investing in the likes of Square, Tesla, is that when you see a company that excites you this much and you think it's a no-brainer, like it's a no-brainer that this company is going to come massive in the next 5 years, you got to back them ideas. And I'm doing that with DraftKings this time round. Maybe I should have made a few years ago Square in 2017 a larger position. Maybe I should have made Tesla, my largest position in 2018, 2019, and maybe I should have backed Shopify earlier on in its journey. And now that I've seen what I think is the next, exciting opportunity out here, maybe the next one I would say is potentially Celsius and Hims. I think those are the two that I would say are probably behind DraftKings for me. This one here, I just can't see it failing. And maybe I'm wrong and it does fail. But yeah, I think it's when you've got the kind of proof of a state that's been there for running for 4 years, like New Jersey, and you go, okay, that's proof. That's the case study. That's the case study that it still does very well in the long term. It still grows fast. It puts in good amounts of profitability when it matures. I think that's what makes me confident on it. So yeah, I did capitalise on more DraftKings anyway. That's what I was trying to say. The long-winded point of what I was on about anyway. So those are the 4 stocks I bought. Hope you enjoyed it. Hit the like button if you're new, subscribe. Let me know what you've been buying in the comment section as always, guys. And I'll see you tomorrow for the next video.